Free cash flow, or FCF, represents the cash a company generates after covering its operating expenses and capital expenditures. In simpler terms, it's the cash left over that a company can use for various purposes, like paying dividends, repurchasing shares, or even reducing debt. The formula for calculating FCF is pretty straightforward. FCF equals operating cash flow minus capital expenditures. For example, imagine a company generates $100 million in operating cash flow and spends $40 million on capital expenditures. Its FCF would be $60 million. 100 million minus 40 million. Understanding FCF is super important for investors because it provides a clear picture of a company's financial health and its ability to generate cash. Unlike accounting earnings, which can sometimes be manipulated by accounting practices, FCF offers a more transparent view of a company's true profitability. Free cash flow is a more reliable indicator of a company's financial health than net income, primarily because it focuses on actual cash flow rather than accounting profits. Earnings, as you might know, can be distorted by non-cash items like depreciation and amortization, which don't really reflect the actual cash flow of a business. FCF, on the other hand, represents the cash a company has readily available to reinvest in its operations, pay dividends, or reduce debt. A company with strong FCF is much better positioned to weather economic downturns, pursue growth opportunities, and reward its shareholders. The enterprise value to free cash flow, or EV/FCF ratio, is a valuation metric that compares a company's enterprise value to its FCF. Now, enterprise value represents the total value of a company, including its debt and equity. The formula for calculating EV/FCF is as follows. EV/FCF equals enterprise value divided by free cash flow. For instance, if a company has an enterprise value of $1 billion and generates $100 million in FCF, its EV/FCF ratio would be 10, 1 billion divided by 100 million. A lower EV/FCF ratio suggests that a company might be undervalued, while a higher ratio could indicate overvaluation. Investors often use this ratio to assess the relative attractiveness of different investment opportunities. Next, let's discuss EV/FCF versus EV/EBITDA, a comparative analysis. EV/FCF and EV/EBITDA are both valuation multiples that take into account a company's enterprise value. However, they differ in the denominator used for comparison. EV/EBITDA relies on earnings before interest, taxes, depreciation, and amortization, or EBITDA, while EV/FCF uses free cash flow. Now, EBITDA is, a measure of profitability that excludes certain expenses, whereas FCF focuses on the actual cash that the business generates. EV/FCF is often considered a more accurate reflection of a company's financial health. While EV/EBITDA can be really handy for comparing companies within the same industry, EV/FCF gives a more comprehensive view of a company's financial strength and its ability to generate cash for its investors. Free cash flow remains, a critical factor when it comes to making informed investment choices. While earnings can sometimes be manipulated, FCF offers a much clearer picture of a company's true profitability and its ability to generate cash for stakeholders. When evaluating investment opportunities, investors should really prioritize companies with a history of strong and consistent FCF generation.